Hey, what's up YouTube? In this video, I'm going to look at the stock of Joyy Incorporated, a Chinese social media company. Very exciting company, growing quickly. Really going to be a very interesting video. If you're new to the channel, hit that subscribe button because I do a lot of stock analysis videos, and that way you can check them all out. Alright guys, let's jump into it. Alright guys, so here's a quick look at the stock of Joyy Inc. It's ticker symbol YY. They are trading at a price to earnings ratio of about 18. The dividend yield is about 1.79%. It's about a $9.5 billion company right now. Now, very interestingly, the short interest is about 12.5%. So 12.5% of their shares have been borrowed and sold short. That is a pretty high level of haters, so that is definitely something to note. Okay, so before we jump into these specific apps that they sell, I want to talk about the company generally. They're generally into live streaming, video games, things like that. Think like Twitch, right? They have an alternative to Twitch. Twitch is much bigger. Twitch has about 140 million users every month regular, whereas they have about 26 million. But just think about the market size in China. That has a lot of room for growth. Here's one of their very popular apps, YY Live, and they make money through advertising through this app. Another one of their popular apps is Bigo Live. This allows you to live stream many games. You can think of it a bit like Twitch for China. Here's another one of their popular apps, Hago. It's a hangout app for teenagers. Now, Joyy also has a very significant stake in Huya. However, they are thinking about selling this stake to Baidu. So we're going to have to see what happens with that. But assuming they hold on to it, it is the #1 live streaming platform in China. Now, as far as what percentage of their revenues come from where, you can see the breakdown here. A third of their revenues do come from Huya, 48% from YY segment, which includes YY Live, and 19% from Bigo Live. I would note, however, that Bigo Live is growing very quickly. I would expect it to account for a lot more than 19% going forward. Here's the revenue by region. 83% coming from China, the rest of it coming from other countries. Here's Joyy's balance sheet. Right away, I can tell you they have a very safe balance sheet because they have very low debt to assets, very low liabilities to assets ratios. I also noticed they have no liquidity issue. The current ratio is over 4. What that means is their current assets are more than 4 times their current liabilities. Very safe there. As well, you got about 44% of their assets are just pure cash, giving them a lot of flexibility going forward. They're not really bogged down by a lot of long-term assets, which is not surprising given their business. Overall, their balance sheet gets an A. It's very safe. Alright guys, so here's a DuPont analysis for Joyy. We're looking at the return on equity and breaking it down into its 3 parts. You can check out my video on DuPont analysis in the description below. But anyhow, the ROE is pretty darn good. It has fluctuated. I'd like to see it get back up to 50% again, but overall it's not bad. What I'm really impressed with are the margins, especially in the most recent trailing 12-month period. They're posting margins of about 32% here. That means for every dollar of sales, they pocket 32.2 cents. Very good margins there. I would love to see that continue. Asset turnover has fluctuated, but it's not bad. Asset turnover tells you for every dollar of assets, how many dollars in sales can you generate. Besides the most recent period where they seem to have had a slowdown there, they generally are about around 1, a little bit above 1 here, about a 1-to-1 ratio. So that's not bad at all. The equity multiplier is the last part. That is the effects of leverage. And again, this company right now has very low leverage. So when you see an ROE of 26%, just realize they could easily double that if they just borrow a little money and, buy some shares back or something. They could easily double the ROE here. So that's something to keep in mind. They're a very low leverage company. Okay guys, we're looking at reinvestments for the company over time. And if you remember our DuPont analysis, it appeared as though the asset turnover really took a dip recently. Well, now we know why. It appears they made a major acquisition in the year 2019 for about $238 million. That significantly increased their total assets, but that probably has not had time to generate the requisite sales yet. So they're still having a low asset turnover there, but I expect that to improve going forward. Now, as far as reinvestment needs, apart from the one-time acquisition there, I love this company because they don't have a lot of reinvestments. You see their CapEx there, very small amounts here. Really not the kind of company that needs factories and warehouses and stores. So you don't have to do any of that. The only investment, if you can call it that, is really just R&D expense. Here we're looking at a vertical analysis where we take the income statement in each year here for the past 5 years, and we divide every number by total revenues, so everything is a percent of revenue. This allows us to catch trends here. For example, gross profit margin, I can see the trend there. It's pretty stable, then kind of going down. Don't love to see that. I see operating margins here around 20-23%, then kind of really sliding down the last couple of years. And then finally, I see net income margin, the bottom line here. That has actually gone up the last couple of years there, going to 13 and then to 32%. So how is it that operating margin is 3.6%, but the final net income margin is about 32%? Well, it seems like we have some kind of unusual items here. We got negative interest expense, so they actually had some interest revenue on the whole. That's one thing. But the most striking thing is really this. There's a big difference between earnings before taxes, excluding unusual items, and earnings before taxes, including unusual items. That tells me they had some kind of unusual item, very positive unusual item in that year, and the year before that actually, which really boosted their margins. That is something to keep in mind because we normally think of these, we call them below the line items, as being non-recurring. So it is kind of a big question of whether that's going to be a continuation or if that's really a one-time thing. Something to keep in mind. Alright, so for a company trading at 18 times earnings, this company certainly is growing. Here are the total revenues in millions over time. You can see they had about 51 million in revenue in 2011. Fast forward to today, it's about 4.4 billion. Very impressive, and it could be a sign of undervaluation. We'll have to dig into that further. Alright guys, so here are some revenue growth forecasts for this company. We're looking at revenues expected to be reported this year of about $3.89 billion, representing about 6% growth over the previous year. Going forward, analysts are pretty optimistic, looking at about 14-15% growth the next couple years. This is very impressive for a company trading at about 18 times earnings right now. Alright guys, so at this point in the video, I'm going to use an intrinsic valuation model to try to value the stock of Joyy. So what I'll do is I'll take the revenue estimates we have provided by analysts, and I'm going to work in some assumptions about margins and how they're changing over time, and ultimately arrive at some kind of estimate for the free cash flows for the next 10 years. After that, we'll use the terminal value. We're just going to assume after 10 years, cash flows can grow in perpetuity at about 2%. So let's jump into the spreadsheet. Alright guys, so here is my base case, my most likely outcome for the company. I plugged in analyst forecast for revenue growth rates for the next couple of years. Remember, you got 3.89 billion, then growing at about 13, 14, 15%, then slowing down to 7. After that, we don't have any data. So I just assume they grow at about 7% for the next couple of years, slowing down to 5% in year 7 through 10 there. Every year after year 10, I'm just going to figure 2% per year. So with that in mind, they're going to go from about $4.4 billion in revenues all the way to $7.6 billion in 10 years. Doesn't sound too far-fetched, sounds reasonable to me. So if that sounds reasonable, then take those revenues, multiply them by our margins to get our profits or net income. Margins were 32% this year, but again, that is a bit of an outlier. I'm looking at a 5-year average of 20.7%, so I'm going to stick with that. Now, given the nature of the company, these margins could increase. I'm just going to assume they stay the same. If that's the case, this is a stream of profits we can expect to generate. Take those profits, subtract reinvestment needs, and you're going to end up with free cash flows. Now, to estimate reinvestments, remember, the more a company grows, the more they have to reinvest. But remember, this company's primary reinvestment is R&D, which is already subtracted to get net income. So they don't really need to do a whole lot of building factories and things like that, acquisitions. So, I'm going to go with a lower reinvestment rate, about 30% for a couple of years while they're in high growth mode. And then that is going to slow down as they slow their growth. So with that in mind, let's take these free cash flows, discount them back, and get the fair value. Alright guys, so here are the free cash flows to equity holders. Got our terminal value. Remember, the terminal value are your cash flows in the terminal year divided by discount rate minus the perpetual growth rate. And we are just assuming they can grow their cash flows perpetually at just 2%. Sounds reasonable to me. Let's discount these cash flows back to present value. I'm going to be using a 10% discount rate, a lot higher than I normally use. But again, remember the risks when dealing with Chinese companies. They don't adhere to the same accounting standards we have in the States. So with that in mind, discount everything back. You end up with a total firm value of about $16 billion or close to $200 per share, making the company quite undervalued as of today. Alright guys, here are my final thoughts on Joyy. The balance sheet is pristine. This is a really good balance sheet. Even though they're a young growing company, they are making money. A lot of these younger companies are reporting losses. So, they're already doing well. They're growing. And honestly, with the cash flow analysis, it's too good a deal to pass up. For me, I'm definitely going to buy. That being said, I could see limiting the size of your position. It has a lot of short interest. Do those short sellers know something that we don't? It starts to be concerning when you have short interest that high. And when it's too good of a deal, honestly, it makes you worry. But, in general, I'm not going to pass on something because it's too good of a deal. I made videos on Baidu, made videos on Lenovo. Those were both really excellent deals. And the stock price pretty much shot through the roof after I made the videos for both of those. So is this the next big Chinese stock? Hopefully, this was a nice trend. Hats off to Dr. Plays for recommending this stock. I'm going to buy some. Let me know what you're going to do in the comments below. Thank you for watching.